Well, welcome everyone. We're going to start our sustainable investment seminar. My name is Rick Prime. I'm the founder of Prime Wealth Management, an HFG company. HFG Trust is based in Kennewick, Washington. They manage about $1 billion in investments for clients. I'm an advisor running their offices in Berkeley, California, and Roseburg, Oregon. I became part of HFG Trust the first half of the year because we share the same devotion to be clients' financial partner for life. My background is I earned my MBA at the University of Chicago with concentrations in finance and marketing in 1982. I worked in Silicon Valley as a chief financial officer for startups for about 25 years prior to starting Prime Wealth Management about 16 years ago and subsequently joining HFG Trust. I'm also a certified financial planner. Some of the professors who were at University of Chicago when I was there were also advisors to Dimensional Funds today, where Joe Chi works. Joe Chi is going to also be part of this presentation. He's the head of responsible investments and serves on the investment stewardship committee at Dimensional Funds. He previously served as the co-head of portfolio management and chair of the investment committee, and he joined Dimensional in 2005. Joe earned his MBA at Anderson School of Management, University of California and UCLA. And while at Anderson, he received the Fred Western Award for Academic Excellence in Finance. He's also a CFA chart holder. He holds a JD from University of Southern California and BS cum laude and an electrical engineer from UCLA. I'd like to start with brief slides before I transition to Joe in talking a little bit about what sustainability means to me. Micah is the HFG marketing manager and digital guru, and he's going to help me go through these slides. This is the standard disclaimer. So the agenda is I'm really going to talk about how I define sustainability and just the enthusiasm for this area and how fast alternative energy is growing. Next slide, Micah. So if I look at the dictionary, sustainability is like a resource that is not depleted or permanently damaged by using sustainable methods. So I think of sustainability as kind of like a lake in the mountains where the water's evaporating, but the river's coming in and the snow melt is keeping it within a reasonable level. And although the rainfall and the snowmelt may vary from year to year, it stays within a reasonable range. However, if the snowmelt drops and it dries up, then that lake is no longer sustainable. So some people feel sustainable is necessary to continue to support life on Earth. That may be an exaggeration, but the description of the lake tells you that it's very necessary for life within that lake. Next slide, please. But from a business standpoint, I like this quote from McKinsey and Company that the conversation is not about shutting down industries, it's how we can transition in a cleaner, more sustainable, resilient way that doesn't continue to put the planet at risk. So sustainability and ESG sometimes get mixed up. ESG refers to environmental, social, and corporate governance factor. So sustainability is really the environmental part. And we're mostly focused on that because that's the most popular part, plus corporate governance. And later on, we'll talk about the few social factors that we use. So This chart, the top chart, I'm showing the billions of dollars that are flowing into sustainability funds, and the bottom chart is the cumulative amount. The point is that 1/3 of investments under management are now being invested sustainably in this country, and it's mostly being driven by the top pension plans of the world, like CalPERS in California, New York State, the state of Norway, and so on. So you're not alone in your interest in this area. In this chart, this is a survey of how interested people are in sustainability. On the right side, the green bars is for millennials, and the dark green is how many are very interested. So 70% of millennials, 40 and under, are very interested. The left bar is the general population. 49% of the general population is very interested in this area. 85% are somewhat interested. So this is a real opportunity, and only a minority of advisors have an offering here. So I'm very excited to be part of HFG and Dimensional, where we're addressing your need and interest in this area. Now, let's look at the impact. This is a chart looking at the sources of electricity from 1950 to 2019. And I would just make the observation, if we look at coal, it's declined from 39% in 2014 to 20%. In other words, just in this last 6 years in this chart, coal is a percentage of electricity it produces has dropped in half. So something's happening, and wind power and solar, although it's the smallest part, it's the fastest growing. Here I take a look at investment in billions into renewable energy in 2000 and 2019. And I would just make the observation, during this 10-year period, it's doubled. The countries making the biggest investment in this area today is China, the United States, and Europe. And it's driving down the price of alternative energy dramatically, which is a good thing. Okay. Here I take a look at wind power in the United States, and I want to point out that the 4 biggest states in wind power is Kansas, Iowa, Oklahoma, and Texas. They produce 52% of the total wind generation in this country. And if you've watched the news in the last 18 months, you know that these 4 states tend to be more conservative, or red states. And the reason they're doing this is because windmills is a cash crop for them. In other words, if you're a corn farmer in Kansas, you get paid about $1,500 a year for a windmill company to put a windmill in your cornfield. So if you put up 100 of these, you're getting $150,000 a year. So this is happening not because of public policy, it's happening because the economics make so much sense, and this is the new cash crop for these farmers. So what we do at Prime Wealth Management and HFG is we can design a portfolio using most of the sustainable funds available at Dimensional. And this is just an illustration of a portfolio. It would be different depending on your risk profile and whether it's taxable or not. So now I would like to transition to Joe and explain the commonality between HFG and Joe is, well, HFG and myself, we're very enthusiastic about the academic approach that Dimensional takes. And Joe's going to explain how They start with the basic dimensional screen and then their approach to adding the sustainability screen. Go ahead, Joe.
Okay, thank you very much, Rick. I'm going to try to share my screen now, and hopefully this will work. Well, I don't want to waste time. I apologize for this. I'm going to try to get this back as we talk. One thing for the audience here, I very much want to encourage questions as we go along. So please do submit those through the Q&A chat. I find that often this particular topic of ESG and sustainability investment just covers so much ground that oftentimes we don't necessarily cover a question that people have about it, and so it's very helpful if you just submit a question, and we'll try to get to it during the seminar. I think what I'd start with really then is Rick discussed an element of sustainability investments related to a particular energy generation, but sustainability goes well beyond that in terms of what's causing climate change. Really, in our discussions with climate scientists, they really focus on one thing, which is greenhouse gas emissions. And greenhouse gas emissions occurs a lot through utilities and energy generation, also occurs through many other processes that happen. So that's really encompassed within the scope of what Dimensional focuses on in our sustainability funds. But before I get there, and I would really want to just talk a little bit about some of the terminology, because the vernacular being used in this space can be completely overwhelming. So let me try one more time to try to find the right screen here.
We could have Micah host it as a backup if.
Yeah, Micah, can you do you have the ability to pull up that screen? I'm looking for the ESG terminology screen.
Yeah, just give me one sec.
And we did test this out earlier, but for some reason it's not showing up now.
So Joe, what does, in your mind, what does ESG mean and how is it related to sustainability?
Sure, and that's actually where I want to get to, because the slide I wanted to show has a lot of terms in it. You talk about stakeholders, talk about engagement, activist investments, UNGP, UNGC. Just the amount of terms out there is continuing to proliferate. And what I really want to bring it back to is just the term of ESG, which stands for environmental, social, and governance. And so the good news is that you don't have to know what all those terms mean, because you often hear about people talking about one or the other. In short, the idea behind ESG is that there are aspects about companies, business practices, which have an impact relative to the environment, that's the E, relative to social issues, that's the S, and also relative to how they govern themselves, that's the G. Our view, first and foremost, even though G is the last letter in all this, is that the environmental and social practices of a company really flow from its governance practices. And so that's a very important thing to keep in mind. There we go. That's the slide I wanted to show you. It's a little bit anticlimactic now, but the point is, you hear about all these terms. I'm here to tell you, you don't need to worry too much about them. Really, it's the next slide. So thanks, Micah, for that. If you can go to the next slide. There we go. Environmental, social, and governance. And what I wanted to point out here was that we believe that G is the one that informs the E and the S. So a company's policies and practices, whether they're environmental, social, or other, in terms of how they're going to invest capital, how they're going to deploy resources, the strategic direction, all those things flow from its governance, because leadership begins at the top, and so we do focus a lot on governance. But separate from that, we also understand investors, such as Rick, have other concerns as well beyond just investing in a way that really makes sense from a return and risk standpoint. And so you can use ESG to also focus on specific environmental or social concerns. And so that's what we've attempted to do with our social and sustainability funds, is to provide an investment solution, first and foremost, that we think is a very, very sound investment solution, which also meets the needs of investors who want to align their values with specific ESG goals. And what Rick has outlined really is an interest in sustainability. And one way, as Rick defined it, is he's thinking about of the lake and making sure it's available for future generations. It's a very, very tangible way to think about it. You might think that UN has a very similar definition, which is to make sure that the environment can support and sustain not only the needs of the current generation, that's us, but also future generations, our kids and our grandkids. And that goes into so many different areas. So bottom line is, for people concerned about the environment, in speaking with climate scientists, we do think that the primary driver of climate change that we're all experiencing now, it used to be that we only focus on the future generations, but as we know, we are experiencing it now, the current generation. We see this in terms of extreme weather events, heat waves, droughts, tornadoes. They're increasing not only in frequency, but in magnitude and duration. And so these are things that we all should be very concerned about. And what's driving it is greenhouse gas emissions. So with that in mind, the sustainability strategies that we put together really do focus on reducing exposure to companies with high levels of greenhouse gas emissions, and also fossil fuel reserves, because those are the oil and coal. These are the reserves of fossil fuels that are going to drive future emissions going forward. Looking here, no questions here. This slide was really just meant to show you that this is some of the governance that we do, but I don't know if we have any questions on governance. Why don't we just turn to the next slide then. So this shows a history of the ESG solutions that we provide, and I hope it comes out through clearly, because I can't really see my screen too well here. We started providing systematic ESG solutions that focus on specific environmental and social strategies beginning in 2005 with our social strategies. In 2008, we launched our first sustainability strategy. That was a US core one strategy as well as an international core strategy. These are very broadly diversified solutions that focus on companies with smaller size, lower relative price, and now higher profitability, because we believe that's what creates a good investment solution. But they also have the additional benefit of having lower exposure to companies with higher greenhouse gas emissions and fossil fuel reserves. And these are the strategies that Rick had referred to earlier. We also more recently added a emerging markets sustainability strategy, and also we have the fixed income sustainability strategy too. And all of these really do focus, like I said, primarily on reducing exposure to the fossil fuel reserves and the greenhouse gas emissions, because that's what we believe is really causing the rapid change in climate. We've talked about this. Rick, any specific questions you want me to highlight on this?
Well, why don't you, what would be interesting, Joe, to explain how your regular investment approach, and then how you you add sustainability screens so that you can explain that to a certain extent you attempt to let investors have their cake and eat it too, in terms of trying to get higher expected returns, but still screen out unsustainable industries.
Sure. Well, let's take a step back then, and I won't start with the sustainable aspect first. What Dimensional has done for many years is focus really on the financial science behind investments. What drives expected returns going forward, and how best to translate that into a good investment approach. And we've been doing that for over 40 years now. And what the science tells us, and what the empirical data shows us, and what the life track record shows us, all three, is that if you focus on companies with smaller size, lower relative price or deeper value, and higher profitability, that if you buy a basket of these stocks and you do it in a very cost-effective way, and what I mean by that is, trade smart, don't have high turnover, be very well diversified, that over time you should expect to outperform the market. And we've been doing that for decades, and that's worked very well for our clients. Now, the nice thing about that kind of approach is it also serves as a really good platform for being able to apply a sustainability overlay to it without necessarily having to sacrifice those drivers of expected return. That's a pretty key element, because when we were asked to launch sustainability funds back in 2008, actually even earlier, what we want to do is make sure that if we're going to do a strategy that has sustainability as a focus, we still want to make sure it's a good investment strategy for our clients, because we want them to have a good investment outcome. And what we saw out there in the space was really pretty much the same thing. Most of the so-called green funds, back then they were called green funds, not sustainability, they were very concentrated. They were often really devoid of all energy, utilities, and materials. They had high fees, high turnover, and not surprisingly, they had very poor performance. And we didn't want to do any of that. So we thought, how can we meet the needs of a sustainability-oriented investor and still provide them with a good expected investment outcome? And we came up with a process that at the time was very innovative, innovative enough that we actually had several patents on it issued. And since that time, now you see commercial indices and other portfolios following a like approach. So we're very proud of that. It's something that allows us to use not only our science, but also our pragmatic experience in managing portfolios to create something that we think really works well. So how it works in our funds is we focus on, in this case, greenhouse gas emissions intensity and a few other considerations that we think are relevant for sustainability-minded investors. And what we do is we come up with a score that allows us to rank companies within their own sectors, because one thing to realize, I mentioned this before, emissions vary by company. Utilities have high levels of emissions, but also some utilities are trying their best to do better than other utilities. And it wouldn't be fair to compare the, say, best utility with the worst healthcare company. We want every company in this portfolio to be rated, we'll say, on an even playing field with its peers. So what our approach does is we rank companies relative to their peers, given the scoring system, which uses primarily greenhouse gas emissions intensity. And then we systematically underweight or exclude the worst performers and gradually then overweight the best ones.
Joe?
So, yeah.
I wanted to emphasize something you said earlier, and then talk about the scoring. And what you said earlier is when this industry started, the funds were very expensive. And 15 years ago, if a client came to me and said, I'm interested in investing sustainably, how will that affect my returns? Back then, we had funds like CalPERS with very high expense ratios. And I said, well, it's like going to Whole Foods. You're going to get a better product, but you're going to pay a lot more for it. The reason I'm very excited about Dimensional's approach is they figured out a very low-cost way to do the same thing without sacrificing returns, because instead of using, to be blunt, a lot of overpaid managers to pick the winners and losers, they just do a lot of the investment up front and come up with an academic way and then implement it with computers. So I just wanted to emphasize that. I don't know if you want to add anything to that, and then it would be great if you could talk a little bit about the criteria you use to under and overweight the sustainable companies.
Sure. Yeah. Well, that's the thing. First and foremost, we know that expenses, whether they're in the form of management fees or expenses paid to your custodian bank or your accounting, those all impact your returns and often are the part of the biggest detractors from overall returns. So it was important to keep a systematic approach where you can keep costs down. But at the same time, you keep in mind where the drivers of expected return come from, the tilt towards smaller size, deeper value, and higher profitability. And so the patent allowed for that, because when you underweight the worst companies or overweight the better companies within the same sector, and you start with a very diversified set of companies, which is what we always do, you can still have a portfolio that ends up being tilted towards smaller companies, tilted towards lower relative price, tilted towards higher profitability, and tilted towards companies that have lower emissions intensity or fossil fuel reserves. And at the end of the day, that sort of gives you what you're looking for, Rick, which is that the higher expected return plus alignment with your sustainability values from the standpoint of lower emissions. And it's something that really I think is not only important to do, but also important to be able to show impact to your clients. And so what we did, since the time you've been investing in the funds and using them for your clients, is we provide a lot of transparent reporting so people can actually get a sense of, what is my investment doing relative to, say, the market. Micah, can we turn to, I don't know what slide it is. It's probably 3 or 4 slides down here. Keep going. There we go. So what I want to show here is this is reporting that's available to all of our clients. And this one slide, I think, captures a lot. There's 2 graphs on here. The left-hand graph is the greenhouse gas emissions intensity. And as we talked before, greenhouse gas emissions drives really most of the climate change out there. Some of it's natural, you can't really control, but a lot of it is what we call anthropogenic, which is man-made, which is what's happening in the companies that we invest in. And what you see here are on the left-hand side is 2 bars. We see on the left-hand side in gray, this is showing the emissions intensity for the Russell 3000. The Russell 3000 is a very good proxy for the US stock market in total. It's basically the largest companies down to about the 3,000th smallest company, and that covers 99% of the US market. And what greenhouse gas emissions intensity means is if you take a company's total carbon equivalent, carbon dioxide equivalents, and divide it by a metric like their revenue, it gives you a sense of how much are they emitting per unit of revenue or sales. And why do I say equivalent? Because greenhouse gas emissions goes beyond just carbon dioxide. There's actually 7 different gases that are captured by this, methane and other gases that you might not typically think about. Many of these gases are actually much worse than carbon dioxide. Methane, pure methane, if leaked, is about 80 times worse than carbon dioxide. So that's something to keep in mind. So you convert all that, and then you come up with a way to measure companies with each other relative to their greenhouse gas emissions intensity. And you can see here for the Russell 3000, that metric is about 135 tons of CO2 per $1 million of sales. So that's what the stock market, the US market is in total. What our metrics look like for the US Sustainability Core 1 portfolio, which invests in about 2,000 of those companies, so very diversified, is a reduction of almost 78%. It's 30 relative to 135. So it's a very meaningful reduction. Now, sometimes people ask us, well, why isn't it more? Well, a bit of background on greenhouse gas emissions. People may not realize it, but we actually emit a lot of greenhouse gases just by using electricity ourselves. Because when you turn on the lights, when you turn your air conditioning on, we're using electricity that's generated from a utility, and that utility is burning either coal or gas, or hopefully a large part is coming from wind and solar as well, or nuclear. But either way, it is generating some amount of greenhouse gas. So it's very, very hard to get it to zero, because it means companies aren't really using any electricity for the most part. That's not really possible. So what we do here is achieve a very meaningful reduction. That number isn't static. It does vary over time. It tends to vary between the low 70s and maybe low 80s in the US market. And so we hope that overall both levels keep going down, by the way. As technology improves, it should keep going down. But relative to the market, what we can do today, it's a very meaningful reduction. And then on the right-hand side, this is potential emissions from reserves. And here you do see pretty much complete removal of reserves. And the reason for that is fossil fuel reserves are, companies are going to sell these, right? That's what they do. That's their business if they have them. Those reserves then get turned into future emissions, whether it's by a utility or by us consuming, directly, whether we burn it in our internal combustion engines. So this is something that we're able to achieve a much greater reduction on. And overall, these are very meaningful for people that want to have exposure to less of the drivers of climate change.
I think it would be interesting, Joe, to look at exactly what your screen, how your screen works and what are some of the other things. Sure. And then maybe we could look after we explain that at one or more of the questions that have come up.
Sure. Let's go back to the previous page if we can, Micah. One more before that. Yeah, here we go. So yeah, so this is more detail on how we are able to accomplish what I showed you in that previous graph. And this is a pretty noisy page, so I'll try to cover only the more salient points, just because I'm not a big fan of noisy pages. There's really three things going on here, and you see three different segments of this chart. On the left, this is emissions-focused exclusions. This is a portfolio-wide exclusion where we're looking at greenhouse gas emissions intensity and potential emissions from reserves. And what we're saying here is, I don't really care what industry you're in. If you have a lot of reserves, or if you have really high emissions intensity, we are going to exclude you or underweight you. And that brings down the emissions intensity and reserves by a lot. In parallel with that is the middle process. This is the one I referred to before, which is the process that our patent covers. This is a process where we score companies against each other, and then we compare them against each other. We do use, as I mentioned before, the primary consideration here for the scoring is the greenhouse gas emissions intensity, and you see that is at 85%. And then we have four other considerations, which are 15%. This is land use and biodiversity, operational waste, toxic spills and emissions, and waste management. So those we consider to be relevant to the issue as well, but not anywhere near as impactful as greenhouse gas emissions intensity. You could throw other things in here. You could throw recycling efforts. You could throw in compliance with environmental reporting. The issue is that when you start to focus on more criteria, at the end of the day, it's very hard to show reporting on some of these, and they tend to offset. So we chose to overweight, really focus and emphasize on greenhouse gas emissions because, when our discussions with the climate scientists, that's really the most important. So that's the second process. And what we do here, once we do get a score, is then we will rank companies against each other, and then we will exclude the bottom, say, 10% of the worst performers. We might underweight the next set. We might neutral weight the middle. We might overweight the best companies. And that also then rewards companies within their sector that are doing well. It also continues to decrease the overall emissions levels that we've talked about before. And then on the last side, on the right-hand side here, we have some additional elements. Now, some people might refer to these as more socially oriented. For instance, coal's obvious, but palm oil, factory farming, child labor. The reality is that a lot of what people might consider to be social also has a fair amount of overlap with the idea of maintaining an environment or world that is sustainable for not only current or future generations. So, tobacco obviously is one that we think directly impacts people's health, and so that is a sustainability issue. Factory farming is one where sometimes people think, maybe is that an issue because of concern over the animals? But really, it's not. Factory farming is associated with very intensive emissions of methane, and that is very bad for the ozone layer. And once you destroy the ozone layer, you get obviously emissions of greenhouse gas emissions, and less. It's just something that doesn't reflect the radiant heat from the sun as well. So there's lots of tie-ins to the overall warming of the Earth. So these are meant to be an acknowledgement that they are related to the environment and the ability to sustain ourselves. They do have some crossover to some of the social concerns. Overall, these exclusions are not very large relative to the whole universe, but they are something that we do include as well. Does that address the question, Rick?
Yeah, you addressed it very well. There is a question that, I don't know if you see it, but that Dimensional has a very excellent approach to do this in an effective way, to try to continue to weight higher expected returns and do this in a low-cost manner. But it looks like the question is there, it may be too expensive to do this, is there thought being put out in the future where it could be done on a more a la carte basis? If there's a particular thing, like what if an investor liked all of this, but they were against nuclear power or something more specific? It seemed like it would be prohibitively expensive. Has Dimensional given any thought to doing something like that in the future?
Absolutely. And we are hopefully by the end of this year going to be rolling out what we call customized separately managed accounts too, which can help investors really customize your particular ESG criteria. So look for that. It's not available yet. We are hoping to launch that in Q4. So that could incorporate some additional considerations or not incorporate some considerations as well.
Okay, very good.
By the way, the question on nuclear is one that is often quite a sensitive topic. I'll touch briefly on that because I don't know, it's nobody wants a nuclear plant in their backyard, and we certainly know of the horror stories of not just Chernobyl, but more recently Fukushima, 3 Mile Island. We do believe that at the end of the day, nuclear power is probably going to have to be part of the solution if we are going to completely transition to a net zero world. Why is that? Well, wind and solar can only do so much, particularly if you need energy on demand. Particularly in times of surge, for instance, in extreme heat waves, people are running their air conditioning. we've had a lot of cases where there have been brownouts, rolling brownouts in California and other parts of the world. Solar and wind are only available during parts of the day. Solar during the day and more so during parts of the year. Wind, that's a very tough one. You can't really control the wind. So you need to be able to store energy for on-demand use as needed. That's going to have to go into either batteries or maybe hydrogen is a storage technology that's being looked at. And that will definitely help. But if you think about the world's consumption of electricity, I don't know that's going to get there fast enough to avoid what people refer to as a tipping point. We are at right now about 1.1 degrees Celsius above average ambient temperatures above pre-industrial levels. Really, people have looked at 1.5 and 2.0 as really, if we get back there, it's going to be very, very hard to go back. And so, will we get there in time with technology? I hope so, but it's it's hard to say. But we do have a technology right now that is constantly being improved in terms of safety and efficiency, and that's nuclear, and that may have to be part of the answer. So I only mentioned that because the question referred to nuclear in particular.
Mm-hmm. And here's another one. Are carbon offsets included in dimensional screen?
I love that question. Carbon offsets are not included. Now, why is that? Well, there's lots of ways that companies can refer to themselves in terms of their overall net carbon. What we use is Scope 1 and Scope 2. And I'll give a little background on that. Scope 1 is direct emissions. For instance, if a company has a fleet of cars, that would the emissions from those cars, if they're not electric, would be considered Scope 1 emissions. If they have refrigerants, a facility that has refrigerants and uses, emits greenhouse gas emissions, that's Scope 1. Scope 2 is indirect, and so you can think that probably most companies' Scope 2 emissions are higher than their Scope 1. Indirect emissions typically is going to be consumption of electricity. Very easy to calculate. All you got to do is take a look at your energy bill, figure out which utility provided it. Utilities, I think, are required to report a mix of how they generate their electricity. Given that mix, you can figure out how much emissions they have per kilowatt hour used. And then you can figure out what your Scope 2 is because you use that much electricity. So for most companies, Scope 2 is a much bigger component than their Scope 1. Scope 3 is what people really talk about nowadays as a measure of overall emissions. And so what Scope 3 is your indirect usage of emissions either throughout the supply chain. So if you purchase products and services, how much emissions went into producing those products and services? And if you sell products and services, how much emissions will be generated by people using your products and services? And that's a much bigger picture. You can imagine that can be very difficult to measure, and it's not widely reported either right now. So we actually did it ourselves. This year we measured our own Scope 1, Scope 2, and Scope 3. Now it's hard for us as a company that doesn't have operations, beyond providing investment services, but it was a bit of a challenge. And so Scope 3 is not what we use in measuring emissions. We do use Scope 1 and Scope 2 in the scoring, as I mentioned, and also in the exclusions that we talked about earlier. Now, where do carbon offsets come in? Carbon offsets are investments, or we call them investments, but really they're just basically companies paying money into a project that is a forestry project, a cook stove project, or some other project that arguably reduces emissions, either through taking out emissions from the atmosphere or reducing the amount of emissions that would have happened without that project. Those typically are not included in a company's Scope 1 or Scope 2 or Scope 3. Companies can tell you that they've offset their Scope 2 with carbon offsets. One issue, though, is a proliferation of low quality offsets. There's no regulation in this space. We hope it will come, but the range of carbon offsets goes from $1 a ton to $1,000 a ton, And so if companies can buy themselves out of having emissions at $1 a ton, you have to ask yourself, how what's the quality level of those offset programs? No one's even regulating it. They claim they offset everything. It costs them all of $15,000 to offset a whole year's worth of emissions. To us, it's not very reliable. It is an area that we've looked at very closely. And I've talked to a lot of people in the space who are looking to develop ratings, more objective ratings on these types of projects. So right now we don't use carbon offsets. I love that question. I probably took longer to answer it than I should have, but it's an area that I think is very worth looking into, and I hope it develops in the future.
And then I had a question. I'm very excited that I can create fairly complete portfolios, but in developing those, I'm curious, when you apply your sustainability weightings, are there any differences or nuances in other markets besides U.S. equities, like international or emerging growth and in fixed income or bonds?
There are some differences. One is in the reporting levels. So emerging markets has the lowest level of reporting, but still then it's pretty good. And then the vendors that we actually use multiple vendors for data. They will model the expected emissions for companies that don't provide them. And we actually spend a lot of time cross-checking between vendors because it's important to have good data quality. So I would say that the self-reported coverage varies. You might be surprised that the US is actually in the middle of the pack. Europe is the highest. And the reason for that is Europe has really been pushing on sustainability for a lot longer than other parts of the world. So many of the companies are required to report, for instance, scope 1 and scope 2, and that's going to change over time. So that's one thing. A bigger challenge is in fixed income space, because many fixed income strategies, including dimensionals, will invest in government bonds. And whereas a company's emissions are pretty easy to measure, measuring a government's emissions is a much more challenging exercise. It's one that we continue to engage with experts on. Experts like Michael Gillenwater over at the GHG Management Institute. He was one of the lead convening authors for the IPCC. That's the scientific panel that the UN uses. And he was also one of the original drafters of the GHG protocol, which is still used today. So we've been talking to experts about that. It's not an easy one to solve. The good news is that in the meantime, we continue to push on the data quality and coverage. This year, or the last year, I think now, time goes by. Last year, we were able to incorporate ratings on agencies and supranationals from the standpoint of emissions. We didn't use that before. So for us, we're very incentivized to increasing the coverage on the securities that we use in fixed income. We were happy to be able to do that last year, and hopefully in the future we can also find a defensible way to use it for sovereigns, because we're not going to market something that we don't really believe in.
That was great. I really enjoyed this, and I think in the my takeaway is that Dimensional and HFG has a low-cost academic way to invest sustainably that has higher expected returns, so you can have your cake and eat it, so to speak. I'm wondering if there's an additional area you'd like to cover, or any last thoughts in the interest of time.
Well, there's a lot to talk about in this space.
Yes.
What I would say is, there's other people out there that this is such a growing space now that people are really wanting to put out products that claim to be sustainability oriented. And I guess if I had any piece of advice for investors in this space, because obviously if you're doing this, you care, and if you care, you should make sure you get what you are expecting to get. And what we find a lot is that people are taking shortcuts in the space. They're putting out a product that says sustainability, or they say low carbon, but they don't give you any transparent reporting. They don't give you any insight into how they actually get to where they claim they will be. And I think it's worth it for people that are interested in the space that you're getting what you think you are. So ask the right questions. It's going to take a little bit of effort. hopefully your advisors can help you with that. But it's worth making sure that you're not just being there's a term out there called greenwashing, and that's a very common term and a problem in the industry these days because people want to get a piece of this for commercial reasons. But ultimately, as an investor, you should make sure that, for advisors, whether it's your personal advisor or for the investment manager you're using, that from a fiduciary standpoint, we're serving your best interests. And so what I would say is education is a really important part of this. Spend the time asking the questions.
That's very good. And, I think if anyone wants to follow up, if they're interested in more information or investing in this area, you should feel free to contact your advisor. You can contact me with any questions, Rick Prime. My email is rprime@primewealth.com, or you can call me at 510-384-1009. And if I don't have the answer, I'll contact Joe or anyone else to see how we can help you. And this has been a fabulous experience. I really, enjoy it, Joe. And you've really shed a lot of light on the space. Like you say, there's a lot to cover. I think we could spend quite a bit of time on it. But do you have any closing remarks other than what you just said?
No, I appreciate the opportunity to come and talk about this. So happy to follow up with any questions that people might have.
Great. Thank you, everyone. I really appreciate your time, and feel free to follow up if there's anything we didn't answer. Take care and have